Fani Shankar, head financial markets at IMG Vysya Bank, now joins in on the show to discuss what he makes of the bond markets as well as his projections for the GDP numbers. Fani, the consensus forecast ranges from 6.5% to 5.5%. What is the GDP number that you're expecting?
Well, we're going with consensus for the last quarter. We think it will be about 6.1, and for the full year, we think it will be about 6.7. But that said, the risks to growth are clearly higher for next year. The estimates are pretty wide, but we think it will be somewhere between 6.75 and about 7%. It's still held up a lot by services. Manufacturing, we hope, will see a little bit of a revival, but it's still services-led growth at this point of time.
Right now, Fani, just focusing on the bond markets, we are seeing yields spike once again. In fact, they did go up to 3-week highs just a little earlier in the day. Is it safe to expect that in the absence of an OMO announcement by the Reserve Bank of India and add to that the 15,000 crore government bond sale on Friday, we could expect to see the yield on the 10-year benchmark end at 8.6 even by the end of this week?
Yeah, 8.6 is not something that's out of the radar. Clearly, the bond market is holding up almost entirely because of the OMOs, and the OMOs are a function again of how the intervention on the rupee side is happening. So in the absence of an OMO, the supply just becomes a lot heavier than the market is willing to take because of the growth in deposits. So if there are no OMOs, or if OMOs are much slower than what the market is expecting, then bond yields have an upside risk. But that said, there's also an expectation about growth slowing down, and slowing down a little more dramatically than what we've seen so far. And if the expectations of a rate cut starts gaining traction, and we're seeing a little bit of a higher probability for a rate cut as early as July, and if that starts getting factored in, and if the growth numbers are any weaker, then there is a little bit of a downside to bond yields.
Right, but Fani, what are you basing your rate cut expectation in July on?
Well, we've not taken a firm call yet, but I wouldn't rule out a 25 basis point cut as early as July. A lot of it will depend really on how growth numbers pan out and how we see the various other indicators that come in. If you look at the macroeconomic side, not too many things are going right. We're seeing a pressure on the BOP, we're seeing rupee under pressure, and a lot of that is really affecting how the underlying economic growth is performing. And inflation is not as big a concern as it was some time back. So even if inflation hovers around current levels, then there will start being some pressure on the monetary policy, that it can perhaps start becoming an aid to growth rather than focus on inflation. And if the focus shifts a little more on growth and inflation does not become a big concern, then there is a reasonable probability of a 25 basis point cut in July. That said, there is also likely to be a CRR cut, because you will need the liquidity to support the intervention and the BOP pressure that's happening as we speak. So there is a fair probability, and it's a little premature to put a number to it, of a CRR cut and a repo cut as early as July.
Among the concerns that you highlighted, the rupee also, and the kind of volatility that you have seen, seems to be one of the big issues. What is the biggest fundamental problem that you foresee for the rupee, and what kind of trajectory are you penciling in?
Clearly, rupee is the single biggest factor at this point of time. And when I say rupee, I mean more the supplies, the BOP issue. The trade deficit is, if anything, is flat. The current account deficit is, if anything, flat, same as last year. So it's really not a concern on the current account. The concern is that the capital flows that we need are not coming in. So far, capital flows have been close to zero this year. I mean, it's really not anything worth that pushes the needle one way or the other. And unless capital flows come in, the pressure on the BOP situation will continue to persist. And for this, the solutions are not short-term. Yes, there can be some measures like the measures that we saw yesterday, or some amount of measures that can bring in a little bit of ECBs or short-term flows. But a lot of the real focus should be on enhancing capital flows back into the economy, which is not an easy game. So from that perspective, we are concerned about how the BOP situation pans out and how capital flows come in.